Chris Lotz with the Pat Lotz Real Estate Group. Thanks for tuning in to another episode of Beyond the Keys of Pat Lotz podcast. As always,
Pat Lotz.
Coming to you again, second episode in a row from our new studio. We're excited about it. I'm excited about it.
It's really nice. Yeah.
We just listened to some of the audio and
Clear and crisp.
we should have bought these probably a year ago.
Yeah.
No big deal. We're here now. Today we are talking about what's the best loan for buying a house. There's a lot of different loans out there. There's a lot of great opportunities. Past 2 years, we've seen a lot of cash and conventional because things were competitive.
Right.
So cash is king. Is that true?
Not necessarily. It is not necessarily king these days.
Okay.
Reason being is you've got two offers. One's cash, one's conventional. And because of the crazy market, cash thinks, okay, I'm king, so I'm going to give you full list price. Conventional says, I really want this property. I'm competing against cash. I'm going to go $20,000 over list price, but I am going to give you appraisal guarantee coverage. So if it doesn't appraise for what I'm offering you, I'll bring the difference in cash. Well, that's $20,000 on the table. A seller's not going to leave $20,000 on the table. They'll take the risk.
Yeah. How long, especially with guarantees, how long are you willing to wait? Or are you willing to wait 30 days for an additional $20,000?
That's what it looks like, yes.
Are you willing to wait 30 days for an extra 10K? Yes.
Yes.
Are you willing to wait an extra 30 days for 5K? Yes. That's a lot of money.
Yeah.
I mean, it
Maybe
could
not.
be.
Maybe not at 5.
Especially, I think 5 to 10 is kind of like the threshold for me for how long I'm willing to wait, because there's also great peace of mind to cash. Close fast.
There
Guaranteed.
is. And I mean, it depends on how you manage your transactions. I mean, you could go back to the cash and say, look, will you come up 20,000? Will you come up 10? And will that be satisfactory to the seller?
Yeah. And those are still things that we're dealing with right now. Like, we just closed on another deal, last deal of 2022, VA loan, still successful on getting VAs and FHAs and RDs. We don't have a lot of RDs and FHAs in our buyer pool
Right now,
but we did have a VA, and it was competitive, but they were veterans taking advantage of a loan program that fit their needs best.
Well, and
why not?
They deserve to take to those benefits. And I always encourage sellers, it is 100% financing. It's this, that, and the other thing. But, it's well deserved.
It's worth an education, though, too.
Yeah.
So maybe a conventional mortgage is the best route for you. But if you're able to qualify for a VA, and normally if somebody qualifies for a VA loan, they're going to take advantage of a VA loan, period. But there's FHA and rural development, or RD. So working with a mortgage lender that's willing and able to educate you properly on all of these loan types to find out what fits your needs best. And we'll talk about why FHA, why RD. And some people are only limited to those two options. Some people are only limited, well, they're not going to only be limited to a conventional mortgage, but they might only be, and we'll get into why that might be the case. We're not lenders, though, either. So consult your lenders at the end of the day. But we can give some rough parameters of why maybe we're seeing people reach for an FHA loan or reach for a rural development loan. So let's start at the top, though. So right now, and we saw a lot of ARMs, or adjustable rate mortgages, 10, 15 years ago.
Yeah, long time ago.
Was that like the standard in 2000? Was it ARMs, or did you have 30-year fix?
Oh, yeah.
Okay.
Yeah.
But what were people reaching for? ARMs or fix, predominantly?
It all depends. I mean, I can't think that long ago. But, people were just really trying to maximize what they could get a house with as little down payments and that kind of thing.
Yeah. So maybe adjustable rate mortgage was kind of stretching yourself just a little bit further to step up to a different house that you may or wanted.
Yeah.
The tough part about ARMs is adjustable rate mortgage. What is it going to be tomorrow? And there's structures of when those rates can adjust. If it's a 5-1, 7-1, 10-1.
Yeah, things that you talk to your lender about, not us.
But what we're predominantly kind of seeing right now is fixed rate mortgages, 30-year fixed or 15-year fixed.
Yep.
And I didn't realize that at one point in time it was required to have 20% down.
Oh, long time ago. I don't even know.
80s, 70s?
Well, I mean, when I bought the house in the 80s, And the mindset was always 20% down. I mean, our mindset is that if you want to buy a house, you have to have 20% down. Yeah.
And I'm sure not even just with that regulation, but I'm sure the stigma and the expectation was always 20% down, period. You can't buy a house unless you have 20% down. The average, and I'm sure that is decreased over the years, especially because homes are getting more expensive. But I'm sure back in the 90s, it was 80% of mortgages were 20% down.
Yeah.
Nowadays, the average down payment across all mortgages is like 8%.
Oh, that's good.
And it's probably lowering.
Yeah, interesting information. Well, the last few years, it's cheap money. Just borrow as much as you can.
Yeah.
I say it's free money.
Yeah, and that's what I say. Like, there's a lot of young people that are saying we need 20% down because our parents are telling us. Well, it's cheap money. And if you don't have to put that money into the mortgage or the home itself, and you can put that cash literally back into the home for a kitchen or for a bathroom and build some equity up or sweat equity, why not do that? Especially if you have such a low down payment. If the difference is between 3% down and 7% down, why not just do the 3?
Yeah.
There's no difference.
Right, unless you're competing, which we found is that if I've got 5 offers and I've got, no, it doesn't necessarily mean this is the best choice. There's a lot of other factors, but 20% down, 10 and 5, everybody's going to go to the 20% down and thinking that is the superior offer, but there's a lot of other moving parts in there.
Boom. Which I think is a disservice to the industry to a certain capacity. Is a lot of real estate agents will sift through offers and go, oh, here's our cash, here's our 20% down, and then here's everything else. Which, just because you have 20% down or 3% down is not a change in qualifications. That's still a pre-approval. That's still a pre-qualification.
Yeah.
We're still going to close. Even an FHA and RD, there's going to be other things. And the problem with FHAs or RDs and VAs is appraisal expectations or needed for repairs. That's something that people don't want to deal with. But that's also something that's easily dealt with for a few $1,000, if anything.
Yeah.
So just because it's conventional 3% down versus conventional 20% down, I think that's a disservice to sometimes people that don't have enough money, because they're looked at as less qualified to purchase a home. And that's not true, right?
That's not the case. I mean, because and that's why you ask questions too. This one that put 5% down, their equity is in the house that they don't have to sell to buy, but as soon as they sell that house after they move into this one, there's a chunk of money.
Yeah.
So it's all on different circumstances. So I try to get educated on each offer.
But then also being successful on the buy side, educating those agents of why we're doing VA, why we're doing 3% down, and it's just making them knowledgeable of, hey, we're doing 3% down because they got X amount of dollars and they want a new kitchen.
Yep.
And they need a roof.
Yep.
So they can't necessarily max out on that and also pay for that.
And that's understandable.
Yeah. So just in brief, conventional mortgages, you can do as low as 3% down.
Yep.
And obviously you could do 100% down, but at that point in time, it's a cash offer.
Yeah.
But normally people, like I said, I think statistically it's like 7 to 8% on average is what is down, but you can do as little as 3% down. FHA is also very similar to that. One thing I wanted to point out before we went to FHA is you need a credit score of at least 620 for a conventional mortgage. So, and then your debt to income ratio has to be 50%.
Is it 620?
620 is the minimum. So why is somebody reaching for a FHA loan? FHA loan more or less would probably have to do with the credit score. I think the minimum credit score for an FHA is, it's right here, 580. And it has to be 3.5 down. So a 0.5 or a 0.5% more of a down payment, but you're allowed to have a lower credit score, 580. So who's reaching for an FHA loan? More or less somebody that has seen some form of financial hardship that's impacted their credit score or lack thereof credit.
Yeah. And a lot of times too, the lender will look at their whole financial portfolio and advise them accordingly.
Why is that possible? Well, FHA, rural development, and VA loans are USDA backed loans. So why is conventional lending in the eyes of Fannie Mae and Freddie Mac different than a USDA loan? It's because it's backed by the government, versus it not being backed by the government. And Fannie Mae and Freddie Mac, these institutions that are requiring guidelines for conventional lending to say, this is what you need to follow. so 2008 doesn't happen again.
Right.
More or less.
Right. So I just got an offer on FHA, and believe it or not, I have not seen an FHA offer in quite a while that was accepted with sellers' concessions. So we're seeing concessions again for the buyer to take advantage of possibly
Closing costs,
discount points, closing costs, prepaid taxes. And so I go, whoa, here we go.
Yeah, we're back. We've been successful in some situations with FHA and RD over the past 2 years, and definitely VA loans. And again, it's just more or less a conversation or a little more work to get the FHA and the RD loans accepted, and that comes down to more or less a real estate agent, if they're willing to have those conversations or knowledgeable enough to have those conversations to get their buyers to the finish line.
Well, too, it's relationships too. I mean, we really have been a lot of relationship business, so knowing that, with an FHA or a VA, I mean, it doesn't really matter. They're qualified, and we're going to get them to the end. People
get a little bit worried about PMI as well, which PMI has existed for a long time. Probably since the 80s or 90s. Don't quote me on that, but it's been around for a long time. And a lot of people are worried about PMI, not having 20% down and requiring to pay PMI.
That extra cost.
But it is what it is. So it's, what do you say? Cost of doing business. If you need a home, if you want a home, if that's what you're looking for to purchase a home and you don't have 20% down, it's the
and
cost of doing
eventually
business.
you can make that go away.
Yeah. Whether you get more equity and appreciation, and you get to that threshold, or you buy it down to 20%. And there's those break evens on amortization charts of when you're going to be at that 20%. But then too, if the market continues to appreciate, 5 years down the road, you might be at that threshold before you need to be that pay down. PMI is lower on FHA loans though. PMI is lower on rural development loans. And that's great because again, it's giving more people an opportunity to take advantage of good loan programs to get them in the door. Right? And this says, what's the con? The pro of an FHA, easier to meet credit requirements and also lending requirements, obviously.
And low down payment.
Con is FHA loans are unattractive to sellers. So why are they unattractive to sellers?
Well, I think that they think that scrutiny of the property is more intense than a conventional mortgage. So they think the appraiser's going there and looking for any major health and safety issues, that they'll have to do repairs to bring it up to a specs. And I want you to know it's not anything crazy.
No.
They're looking for maybe, you have a loose electrical wire. That's a problem. That's
a problem even a conventional mortgage.
That's correct. And, side rails on decks possibly can be an issue based on the height of the deck. Handrails going down. I mean, they don't really. And they're not crazy.
Those exist for one reason. The government views that as a hazard that might cause harm to those borrowers and making them not less likely to repay that mortgage. That makes sense.
Sure.
So, and then the thing that I'm constantly hearing with FHA, RDs, and VAs is livability. And again, back to pitching these listing agents on FHAs, RDs, and VA loans. Being forthright and honest with what your concerns may or may not be, but then always go back to livability. So as a seller, if my home is not considered livable, then I think we have a bigger issue on our hand. And then that goes back to even what we talked about last episode about seller's disclosures. Peace of mind. To make sure that you're doing the right thing, you're selling this good property and clean bill of health onto these new young people.
I'm not an appraiser, I'm not a lender, but as a real estate agent that's been around for quite a while, I know what VA and FHA appraisers are looking for typically. So if I see it, we've got to clean it up.
Cool. FHA. Next one is VA loans. It's again, a VA loan is backed by the government, exclusively for our nation's veterans, obviously, active members of the armed forces, and select surviving spouses. To be considered, you must be able to produce a certificate of eligibility. A VA loan can allow you to buy a home with no money down, and you can also avoid PMI. So no money down, and people are using VA loans for $1 million homes. My buddy Rob, they just bought, I don't know what it is, an $800,000 house down in Florida. VA loan, 0 money down, no PMI. taking advantage of
it.
Taking advantage of a great opportunity.
Yeah.
You'll need to pay a small VA funding fee. You're probably going to pay that more or less with any banking institution. Correct me if I'm wrong. Anyone can really do a VA. Like John can do a VA loan.
Oh yeah.
Okay.
Yeah.
So mostly you're not necessarily doing business with the government. The bank is working through the government or the Veteran Affairs, the VA, to get some of these things approved.
Yeah.
So it is backed by the government, no different than FHA and RD. Any lender most likely can do it. It's whether they have experience with those things or not. But then it's just going through government entities to make sure that we're making it.
Product that they utilize.
Yep. It's not on here, but the next one or the last one for USDA loan that we're kind of seeing or utilizing is rural development.
Because we're in a rural community.
You got to the product needs to qualify.
In areas, it's based on areas.
Yep. And then also too, it could be based on income.
Yep, there's caps on income, and that's all lender stuff, but how much income in the house and how many people.
And why is somebody using a, rural development loan? Well, cash in the bank. If they don't have that 3.5% down, then it might be an option if it qualifies for location-wise.
Yeah.
It might be an option for them to get into a home with 0% down, which is crazy to think about. That's awesome.
But take advantage of it.
Take advantage of it. And I'm even saying it too, inside deals, if you got pocket listings or you're doing both sides and it's a good opportunity for all parties, which we did one in 2021. One, we got them top dollar sellers.
Top dollar.
But then the buyers were able to use, and they were going to use a conventional mortgage when we were competing. But in that situation, when the sellers were comfortable with that list price, the buyers switched over to a rural development loan because it made more sense for them financially.
Yeah.
And that $20K that they had, they put right back into that house.
Which they had to. Yeah.
Lower PMI.
Yeah.
Less restrictions on income requirements. It just made sense for them. And honestly, if it's me, I'm probably trying to take advantage of a rural development loan. I don't think I can financially now, but I think that's always a great thing to look into, an option.
Well, and two, back then they were still low interest rates. So why not, borrow as much money you can, especially that low interest free money, and keep your money in the bank to do your fixes and that kind of thing.
Yeah. Not on this list, but there's also some great options for healthcare providers. Is there any great options for public servants, fire departments?
Oh, I'm sure.
PDs,
I'm not real
teachers?
familiar.
A lender called me recently about a program like that, and it was for public servants, PDs, fire departments. He was saying that he dropped off a flyer at a fire department, and it was about like low down payments or credits back from the government. Just great opportunities for those individuals to get into homes.
Yeah, there are some programs. Actually, John has some of those. Sometimes they come around where they're getting credit backs to some of these public service individuals, nurses, teachers, police officers, firemen. So
the last thing we'll talk about is the last two on here. It's just non-conforming loans, conforming loans versus non-conforming loans. A conforming loan is most likely everything that conforms to Fannie Mae and Freddie Mac guidelines and the government requirements. So a conforming loan most likely gets sold right away to make money. That's how John Adams Mortgage makes money.
Yeah.
They never hold their mortgages. They always sell them out to bigger entities or different entities. A non-conforming loan most likely will have to be held as a portfolio that might not always meet the Fannie Mae and Freddie Mac guidelines. Why would people do that? I guess giving all people or certain people options. Maybe it's investment things. Maybe it's a specific buyer, a self-borrower. And then those banks, whether they're smaller banks, if they're not selling off those conforming loans, they'll hold those non-conforming loans as portfolio debt. They're still making money, but it's more or less a service to buyers.
Yeah, and I don't know the costs involved in non-conforming, but a lot of times you can't get a conforming loan for a development that's not completely finished. It has to be 80% finished before. I don't know all the rules, but
warrantability, and that would probably fall into more of a non-conforming loan. So you got to find the right lenders that are able to do a non-conforming loan.
Yeah.
when it comes to properties that are non-warrantable.
Yeah.
Not at a certain capacity of construction and or doesn't fit a certain criteria.
Yes.
Lawsuits, litigations.
And the best thing is that's when you consult with a lender to let them take a look at your financial portfolio, get your pre-approval so we know what's best for you,
Yep.
and then how we can shop for a house.
Yeah, cool. We're gonna get out of here. Those are all the options. Let's run through them really quick. You got your conventional, your cash.
Mm-hmm.
You got your conventional mortgages, whether it's fixed, ARMs, 30-year fixed, 15-year fixed. You got your USDA loans, your FHAs, your rural developments, your did I say VAs?
I don't think you
rural
said
developments, VAs, and FHAs,
Yep.
and then your non-conforming loan options. All great options, all opportunities to make sure that you can buy a house. So the biggest takeaway is call your lender that you know and trust.
Yes.
Get educated on all of these options. And if a lender is not educating on all these options, it's probably a little bit of a disservice. Luckily, our preferred lender is educating every single person on options that might work best for them.
Well, and two, things change, all the time. So we're not up on all the know-how on all these loans. So that's why, number one, don't talk to me about money. Talk to the lender.
Yeah. I also don't, I say that's not my business. I don't necessarily want to hear those things. So when it's a money question, call the lender. That's the pro.
Yeah.
So thanks again. Chris Lotz.
Pat Lotz.
With the Pat Lotz Real Estate Group. As always, there's lots to love in Livingston County. See you in the next one.
Thanks for watching. Make sure to use those like, comment, and share buttons below. And don't forget to follow us on Facebook and Instagram, and subscribe to our YouTube channel at Pat Lotz Real Estate for more helpful home buying and selling tips. Want a free comparable market analysis? Scan that QR code on your screen or visit our website at www.patlotz.com and fill out the request form. There's lots to love in Livingston County.